Hi, everybody. My name is Tinashe Mukogo from Money and Moves, and this is a brief interactive course on introduction to US stock market investing. And we're going to be doing this course together with Isaac, who's going to introduce himself next. And just to let you know, this is a really like an interactive, practical um, course. So we might interject and stop each other midway, but that's because we just really want to try to get the most for this course for you. So I'll hand over to Isaac to just do an introduction as well.
Yes, thank you so much, Tinashe. I'm so excited to be part of this course. For those who don't know me, my name is Isaac Jonas. I am the principal economist at StreetWise Economics. I am an economist and I also create content as well and do some trading and long-term investing as a retail investor. Over to you, Tinashe.
Okay, so just to start off with some admin, this is not investment advice, purely for educational purposes. I won't read through the whole disclaimer. You can see that on screen, but just to make sure that you guys know that this is not investment advice. This is purely for educational purposes. With that, we'll jump to the uh, high-level overview of what we will cover. So it's going to be, what is uh we might edit this. No, 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 type candy viringa.
Okay.
We'll edit this out.
Oh,
Stop. We'll just chop it up. But
yeah.
type candy kanganisa.
No, that's
Anyway,
okay.
so right. So now this is just a high level overview of what we're gonna cover in this course. And this is really a course an introductory course for people who are interested or just started getting into US investing in the US stock market. So if you're like a trader with like 10 years of experience, this might not necessarily be the course for you. But if you've just started out or you're just starting out investing in the stock market, I've been investing in the US stock market for about 6 or 7 years now. So if you're just starting out, this is exactly the course for you. So we're going to look at the US stock market. We're going to be really practical, just how to even set up your brokerage account, and then like researching your first investment or one of your first investments. So just what that process should look like if you want to invest and increase the chances of you being successful. So as I said, it's going to be really interactive. It's really to try to make sure that you get the most out of this. So if it sounds as if we're stopping each other, it's actually fully planned. It's just so that we really dig down into the most important details. So with that, I'll jump into the first part about the US stock market. All right, so the US stock market. Um, Now, before we even get to the US stock market, there's a couple of things that you're probably asking yourself, or at least questions you should be asking yourself, like why invest in the first place? In fact, not even why invest. What is investing, right? And then with that, then you ask yourself, okay, why the US stock market, right? So to really simplify things about what investing is, um, investing is really just owning a piece of a company, if you think of it, right? Um, and when you own a piece of a company, that some people call it a share or a stock, you get certain types of benefits. Two of those benefits are one of them is you get income, right, which is often called dividends. And then the other one is called capital appreciation, right? So if something's worth $10 today and it's worth $12 tomorrow, you've had an increase in your capital appreciation. And so when you invest, you're basically buying into a business with the hope that the business will grow in terms of capital appreciation, but also will generate income for yourself on a regular basis. Now, linked to that is like, okay, so what's the benefit of investing, right? Um, One of the things is that if you look at like the top 10 not even the top 10, the top 100 richest people in the world, most of those people have made their money from investments, right? If you actually look at how much income a lot of these big time CEOs get in terms of their salary, it's a very small percentage of actual net worth.
Mhm.
And if you think about it, for you to become a billionaire, right? So for you to have $1 billion, if that came all from, let's say, your salary, right? If you think about someone like Jeff Bezos or Elon Musk, who are worth 100, 200, $300 billion, depending on the time. If those individuals were to be paid even just even $100,000 per day, which is a lot of money, right?
Mhm.
It would take them multiple lifetimes just to get to their net worth as of today, right?
Mhm.
Which says that it's impossible to get to certain levels of wealth with just your salary or just your income. The only way is to get capital appreciation and to grow an investment. So if you think about this from your own personal life, if you want to really grow your wealth generationally, it's 100% the case that you have to have investments
Mhm.
because
Assets.
income, investments and assets, because your income, and thanks for stepping in there, um, is not going to be enough to get you there. And the other thing is simply this, right? We ultimately want to gain our time back. And we don't always want to be working for the rest of our lives every single day, right? And one of the ways to do that is if you invest, you can actually, in quotes, make money while you're sleeping because your investments and your stocks are the ones that are working for you, right? If you hear about people like Bill Gates, for example, he's retired many, many, many years ago, but he actually still generates literally hundreds of millions of dollars, if not even billions in times, just
Yes.
from dividends. Without working a single hour, he's still generating a lot of income. So these are some of the benefits of investing in general. Now, why invest in the US particularly? Well, there are lots of reasons, right? But I think one of the biggest ones is that the US is by far one of the most sophisticated markets, most advanced markets, the most liquid markets, which means has the most money, and also historically, for a lot of those reasons, has had the best performance. When you think about your big companies, your Googles, your Amazons, nowadays your Nvidias, all of those companies are listed on the United States stock exchanges or stock exchanges based in the US. So if you want to basically invest in the best companies in the world, the biggest companies in the world, as well as the fastest growing companies, you probably have to have some sort of investments sitting in the US. And so this is why it's really important if you haven't had any investments in the US to really start looking at the United States as a destination or somewhere where you should be um, investing your money. Now, if you want to know about how the markets are structured in the US, we're just going to go over this on a very high level. But essentially, you have different stock exchanges or
Mhm.
markets, right?
Yes.
You don't really need to know all of the details about this, but
Yes.
you'll hear some of these names. And so we just thought we'll just put them on, right? So you have your New York Stock Exchange. This is the oldest and the largest market um, stock market exchange by market capitalization. Basically means
Mhm.
the value of all the stocks listed on that exchange are the biggest in the world, and it's got like your older established companies. Then you've got your Nasdaq, which is basically for your technology and internet-based companies. Not for those companies, but it's the one where a lot of those companies are listed, right? You also have this thing called over-the-counter markets. We're not going to touch on that a lot um, because that's just for stocks that are not listed on these major exchanges, but you can still buy and sell them. But you don't need to know too much about that. The most important ones to know for the purpose of the US is the NYSE, so the New York Stock Exchange,
Yeah.
and the
And
Nasdaq.
there's
So I'll just hand over to Isaac there.
And there's also the Texas Stock Exchange that's gonna be probably coming up soon. But I think you have covered this in detail. So you want me to go to the next slide?
Yes, let's jump to the next slide.
Thank you. Now, it's very important to then understand that there are various investment vehicles that one can then, buy or sell. In other words, you can then own this. So I'm going to quickly explain like what Tinashe mentioned, the stocks. Stocks, you are thinking of just holding a piece of uh, equity in that particular business. So there are various stocks and thousands of them. So the most important thing now is if you want to do individual stocks, is to understand the stocks that you'll be buying. Now we are going to explain and give you an example later in the future. But other people who may not necessarily want to select one individual stock, what they do what are called index funds. And an index fund is basically a basket of companies that are publicly listed. For example, if you look at the S&P 500, it's an index. That is a basket of the top, or I would just say the 500 companies from different sectors that are publicly listed in the US. And you can have technology sectors, utilities, and different sectors. But to then be able to buy shares for those, you can do that through what are called exchange traded funds. Basically, there are some funds like BlackRock, Vanguard, then they just buy, they pool the money together and then they buy and replicate in percentage terms the weighting of that particular index. So some do NASDAQ, some do S&P 500. So SPY tracks the S&P 500, NASDAQ, we have QQQ, which is the exchange traded fund. And there are quite a number of them. Some may be sector specific. Now, mutual funds, we are not going to go in detail, but just for you to know, these are just similar products like exchange traded funds, but the idea is mostly they are like banks, like in Canada here, we have TD Bank and stuff, they can have their products, right? Wherein they pull in resources and then allocate some resources. But the key thing there is mutual funds, usually they have higher fees than exchange traded funds if you want to go with this. Now, bonds, they are more like debt instruments, right? And for some people, they want to have a balance of stocks and bonds because they are believed to have an inverse relationship. In other words, if the stock market is going up, under normal circumstances, the bond prices, they might be going in opposite direction. So some people, depending on your age and your retirement age, some people might want to have fixed income so they can do bonds. Now, some
And
people do. Okay,
just a
go on.
question on the word bond, because I
Yes,
remember in my early days, I couldn't quite understand what it is. So you're saying like if a company
yes,
um, wants to borrow money, right?
yes,
They can sell their um, desire to borrow, let's call it that way, or the amount that they're borrowing as bonds. So they basically say, hey guys, if you want to lend us money, we can give you this bond, which
yes,
we will pay interest
yes.
on. And that's not only just, is it just companies or is it also like, the government that
Yeah.
can also do that?
Yeah, yes, they can be both. Some companies can issue bonds, but also governments. For example, here in Canada, there's the federal government and the municipal, and in the US, we have the state and the uh, government itself, right? And the idea is the most important issue is that institution that is issuing that should have credibility so that they are basically underwriting to say if this fails, we are guaranteeing you that we are going to pay you, let's say, the principal plus interest. So that is very, very important. Now, for some investors, once for me, I go to a certain level in my investment journey, I started thinking about hedging the portfolio. So I started now doing options and also futures to an extent and forex. The idea is that I don't want to just focus on one asset class, but as a beginner investor, I think it is very, very important to understand that the most important thing is to understand the basics of what you are investing in, why you are investing, and your time horizon and your risk appetite. And if you do that, you can then allocate your portfolio accordingly. And we are going to walk you through a simulated example. Now, can move on to the next one.
Okay, so I think this is something that you touched on even on the earlier slide, which is
Yes,
basically like the market indices, right?
yes,
Um, and this is quite closely linked to your exchange traded funds. Um,
yes,
but like the S&P 500 is probably one we're going to talk about a lot because that's something that is sort of representative of the entire market. And you're
yes,
going to hear this phrase, like buy the market or track the market or follow the market a
yes,
lot. And oftentimes what's being referred to is the S&P 500, which is basically the biggest 500 companies um, in US stock exchanges. And this pretty much is like the entire market, the stock market, because these are just huge, huge companies. You also have all sorts of other indices, and there's actually even a lot more than these as well. So it's just to be
yes,
aware of this phrasing
yes,
that's used. But as a beginner, the one that you typically should be quite well versed with is this S&P 500, which is representative of the market overall. Um, Now, one of the things that at the earlier stage, when we talked about why you should invest, is going to be really important in understanding is the power of compounding rather,
yes,
because this is pretty much the most fundamental and I guess important element of investing, right? The
yes,
magic of compounding. Um, because without compounding, investment doesn't really quite work, right?
yes,
And you might have heard that statement for the first time, but we're going to try to do a little bit of an illustration that shows
yes,
you the magic or the power of compounding and compound interest, um, um, or compound interest or compound returns on a stock or a exchange traded fund. So I'll send over to Isaac to try to walk us through a practical
sure.
example. And these are some of the tools that you can actually use
Yes,
to try to evaluate what's going to happen from a returns perspective.
thank you. Okay, so there are quite a number of, calculators online that you can, use to illustrate. But basically, I like the one from Fidelity, this calculator online. So let's say, hypothetically, you are starting with, let's say, 10,000 that you invest today, and you have, let's say, 15 years to invest this money. And you're assuming that, let's say, you're putting it in the S&P 500, the index, which has historically returned, let's say, 10% per year, and you are adding $100 every month. And as you can see here, and let's assume that the inflation is 2%, which is the goal in the US, and the tax rate, let's say you are in the tax rate, let's say tax bracket for, let's say even for illustrative purposes, 20%. Now, what this means is that you can see here over the years that the amount that you will have invested, this 10,000 plus the monthly contribution will be 20, let's say about 23K. But you see that the compound earnings here is the money that is just being compounded year by year, right? So you can see this is the power of compounding interest. So if you can invest your money and you can compound it for 10% per year over 15 years, you will realize that in those 15 years, you can have in total 66,000, right? So this is the power of compound interest. Over to you, Tinashe.
All right, thank you. Thanks, Isaac. So, I think it's just really important to illustrate, and maybe if it's still possible,
Yes,
if we can go back to that
yes,
calculator,
sure.
because
Okay,
it's just something that really jumped at me while you were doing that,
sure.
which is the importance of, I guess, time
Yes,
um,
time in the
in
market.
right? So what we can do is a little bit of an experiment here. Um, So if we were to decrease that time to grow to 5 years, right? So if you just say, look, I'm just going to stick in the market for 5 years, right?
5 years, yeah.
Um, you basically put in 14,000, right? And you end up getting 22,000, right?
Mm-hmm.
Now, um, let's increase that rate of return to 20%,
Yes.
right? So we're doubling this. So we're basically saying, okay, even if you make double the
Yes,
returns that you would ordinarily expect, right? You
yes,
can only grow that um, um, initial investment to 33,000, right? So
yes,
this is really you making really great returns. Now,
yes.
let's do this way. Let's increase the time to grow to 20 years.
Mm-hmm.
And then let's
Yes,
actually decrease that rate of return to, I don't know, 8%, for example. So a little bit lower
8%.
than we would expect,
Yes.
right? And you see that in this particular case, you actually end up making, double the amount of money,
Mm-hmm.
um, even with a lower level of return. Now, let's
Yes.
put that rate of return back to 20%, which is what we had initially,
That
right?
would be insane.
I mean, now
Look
to be
at
clear,
this.
20% is a very, very, very good return.
Unless you are
Um,
Buffett.
unless you're Warren Buffett, which actually
Yeah.
happens to be about his return. I think it's about 25% that he's able to return.
Yes.
But you see that you start off with $26,000.
Yes.
Um, well, you start off with $10,000 actually in terms of
Yes.
your initial investment,
And you're adding
um,
$100 every month.
and then
Oh,
adding in another
yes.
$100. So actually, yes, you're right. Actually, the total invested is about 26,000, and you end up with $500,000. So this is the power of one time in the market, and of course, if
Yes.
you can get those returns, which
Yes.
would be phenomenal if you could get those returns.
Yes.
And actually, if you think about it, 20% might be a bit high, but I think
Yes.
around 10, 12, 10, 11, 12, 13%, if we put that in,
Yes.
um, it's pretty much what you should be able to get just with the
Yes.
basic um, market level returns,
And you can
and you
see
still
the
end up with
difference, right? If I put 12%, you see it decreases to 145K, right? By just scaling it by 8%, which is a lot per year, for
yeah,
sure.
which is a lot per year. Um, but I just wanted to highlight that the power of compounding and consistency, um, and also the fact that you don't have to get 100% returns because sometimes
Yes.
we get greedy to try to get these crazy returns. But even
Yes.
with 20% return, 15% return, 12% return, you can grow a small amount of money into a very meaningful amount um, in a passive way over a
Yes.
relatively short period of time. So,
Yes.
so thanks for that, Isaac. Just wanted to double click on
No
that
problem.
particular topic, and it actually leads well into another two other sort of key concepts as you start your journey. Um, the first is just understanding risk and return,
Yes.
right? Um, you know, investment is very different from gambling. You know,
Yes.
um, gambling, you're taking, you might end up winning $10 million if
Yeah.
you buy a lottery ticket, right?
Yes.
But if you actually think about it from a risk, i.e., the likelihood of you actually coming with a successful result
Yeah.
versus the return,
Yeah.
statistically, it's actually always negative, right?
Yes.
So we're not trying to be, gamblers when it comes to investing. You always have to think like an investor, where
Mhm.
you're just trying to minimize your risk, you know, for the best possible return. So all of these, try to get 100% per year, double your money in 2 years. That's not investing, that's gambling, right? So
Yes.
if that's what you're looking to do, this course might not be for you. But if you're really thinking about building wealth over time and investing and letting your money work for you, that's what you have to do. And that links to the next point, which is setting your expectations out. Now,
Yes.
even within the realm of investing, right,
Mhm.
there's different levels of expectations. If you are about to get to retirement age, for example,
Mhm.
like Isaac mentioned, you might want even safer types of investments like the bonds you mentioned, right? Because it's sort of stable cash flow, stable income. But if
Mhm.
you're like starting out and 40, 50 years or ahead of you in terms of work-wise, you might be able to be a little bit more aggressive in how you invest and what you invest in, right? Because you really want to maximize how much return you can potentially get in a shorter space of time. So there is, even within that investment philosophy, differences in how you approach your investment and how aggressive you are in investing your money. And it's very important early on to think about that and to also look at how much you're willing to set aside to invest, um, and also how you then structure your investment so that you still have enough cash flow, but you're still also investing consistently into the market. Because that's the other thing that really helps, being consistent in how much you're investing, and also having enough cash to be able to identify opportunities where you can bot and invest attractively. Um,
Mhm.
so this is just a basic introduction, just in terms of what are some of the things that you need to be thinking about even before you start to invest. And we hope that we've sort of laid that foundation. The next lesson is we're just going to go into a little bit more of the detail about actually how do you even open an account to invest? Um, what are some things you need to look for? What are things you need to worry about? Um, but that's it for this first lesson on investing.
Yes.
And we'll probably give you some more resources to look into. And I'll just hand over to Isaac if there's any other additional comments or things that you want to drill down on before we get into lesson two.
Yeah, I think we have covered the basics, sort of the basics, the reasons why you want to invest, and also the most important things. I think we will cover more details in the next lesson. Thank you, Tinashe.
Right. So we'll see you guys in this lesson two. Okay.
We are good.
Okay, so this is lesson two, and this is really like hyper practical um, topic and more administrative to some extent. So, and we're going to talk about how to open a brokerage account. Um, Simplified, this is how you get access to the ability to buy and sell stocks or ETFs or any sort of other financial instrument. And Isaac's going to walk us through and maybe explain this in a little bit more detail. But shout out to Wall Street Mojo for this visual.
Yes.
But I'll move over to Isaac just to explain
Yes.
what a brokerage account is,
Yes.
what are some of the things you need to consider, and how you just basically go about the process of opening one,
Yes.
um, to be able to buy and sell stocks.
Thanks, Tinashe. So the first thing is I just want to talk to you, our learners, from my own experience. I am a dual citizen. I'm a Canadian citizen and a Zimbabwean citizen. So for me, I use a Canadian brokerage account. But the point is that a brokerage account is more like a car. Someone can go for a Mercedes Benz, a Toyota Corolla, right? But the most important thing is just a vehicle that can take you from point A to point C. So for me, I use a brokerage account, and it's not a recommendation quest trade. But in Canada, what I've seen is that some banks, they have, brokerage account. So basically what happens in my case is that when I opened my brokerage account, there are key things that they ask you. They want the source of income, what they call like know your customer questions. So what they do is what do you do? What is your source of income? And when you open the account, if they say, okay, we approve, then you have to then fund the account to deposit some money. So in this case, for example, it's $1,000. And this depends if you are looking at the US or in the US or in South Africa, every broker is different. But now, once you open this brokerage account, you now have the ability to now buy and sell shares. Now, what then happens is that once you deposit the money, you have the money that is there, and then it can then grow. But key things that are pertinent for me when I'm trading is I want a brokerage account that have low fees. For example, when I buy and sell, like for example, Questrade now, they reduced the fees to zero. If I'm buying, let's say, for example, Tesla stock, let's say 10 shares, zero fees. right? But they make fees between the buy and sell, the bid, right? Because usually those are different. They will show you in a second. But the most important thing is if I have low fees, now compare it with other Canadian banks. For example, if I'm buying the same Tesla for a trade to buy, let's say one share, they will charge me maybe $10. And then when I sell, I will be charged another $10. So that's $20. So compare it with the zero fees. So that's why it is very, very important to make sure that when you are choosing a brokerage, you look at the fees. So you compare the fees. Number two, you must also understand the products and services that they provide. In my case, I can trade or buy and sell shares for stocks, mutual funds, gold, so the products but I can also trade Forex as well, right? So if you are someone who is looking at the long term, you may want some brokerage accounts that have all those products, right? Some people in the US, for example, you may probably have heard about Robinhood, Charles Schwab. Those are different kinds of, brokerages. But the most important thing is if you are opening a brokerage account, understand that you are free to provide that information that they want. And once you provide that, they will then open the account, and then you can choose to do self-directed investing, or some brokers, they can manage your fund. Usually you have to, look at those options. And I don't know if there's something that you want to add there, Tinashe.
Yeah, so and maybe just to a question in terms of
Mhm.
like if someone who's starting from like zero, like this is the first time that they're hearing about a brokerage account,
Yes.
like um, what would you sort of say they should consider doing? Is it
Mhm.
you start off okay with Googling and saying, okay, what, I want to
Yeah.
open a brokerage account.
Yes.
Um, should they like where can they go to read like reviews?
Yes.
Um, what are some of the ways they can tell that okay, maybe this is something worth looking at, or
Yes.
this is definitely a bit of a red flag in terms of a brokerage account. And
Yes.
then even like when they're filling out all the forms,
Mhm.
sometimes some people get spooked out because they're like, okay, am I saying the wrong thing on the forms, right?
Yes.
Should I, they'll ask, what's your source of income?
Yeah, you must be
What level
truthful.
of education do you have?
Yes.
How sophisticated are you as an investor? But
Yeah.
when all those questions are being asked, like how should someone be responding to those?
Yes. Number one, I would say I would be very truthful because usually they want, they want you to back some of the things. Let's say the source of income. They can say, upload the source of income. But another important thing that I wanted to highlight here is that in Canada and in most developed countries, you must also make sure that the brokerage account has insurance. For example, Questrade has insurance up to 5 million if you're a retail investor, for example. So let's say I have 5 million
Hmm.
and then the brokerage account goes bankrupt. I would be paid back up to 5 million.
Oh, sorry. But
And whilst we are waiting for Tinashe, another important thing is now you may have heard about Silicon Valley Bank in the US, right? So depositors were refunded their money. So that is something that is important. But when you look at the reviews, people usually comment. I go on Reddit, I go on these other platforms, and what they do is I like to take, some feedback from what people are saying. And usually with social media, when you do your research with ChatGPT, you look at maybe, let's say, the top brokerage accounts in South Africa, in Zimbabwe, for non-Canadian or non-Americans. You can use the different ways to just look at the research. But at the end of the day, it must have insurance for your money because it's your money, right? Number two, it must have, for me, I like a brokerage account that is low fees and also to just make sure that it has many options for me to do if I want to do Forex, if I want to do options, if I want to do stocks or index funds. So a broker that can do satisfy me on that, then I would definitely consider that. And those are the key things in my view.
yeah, so that's basically what you need to do to open a brokerage account.
Mhm.
So just to give a quick recap, look online, research, ask people who you know who are already invested in the stock markets what brokerage accounts that they're using. Go through the process of completing all the steps of the registration process. Just be honest and truthful. And then once you've done that, making sure that they've got, some of the basic things, which you will be able to get if you ask around people what they're using. Are they insured? Are they reputable? What are the sort of fees you have to worry about? Then you open your account, and once you open your account, it's funding it. Um, a lot of the times for US, if you're not in the US, you probably have to use something offshore account. Uh, but yet again, ask around, ask people, and they'll give you some guidance on how to do that. And then once you're funded, now you've got money in your account. Then you move on to the next step, which is lesson 3, researching your investment before you make it. So we're going to move on to lesson 3 now, and how to research your investment before you start. And yeah, so we'll see you on lesson 3.
Thank you. Okay.
So welcome to lesson number 3. And here we're going to be talking about researching your first investment. And as we said, we're going to be as practical as possible. So we both own Apple stock, one of the more significant positions as well in the portfolio. So we're just going to talk through how one person can research your first investment. And this is not investment advice. The fact that we own Apple doesn't necessarily mean you need to own that stock as well. But it's just a useful, practical example of what are some of the things that you need to do to go from thinking about buying a stock and then researching and reading up on a stock before you make the decision to actually invest. And this is a really important part because sometimes, especially with the ease of buying and selling on online platforms, people tend to sometimes just buy without thinking, right?
Yes.
People spend more time deciding what to wear than actually buying a stock, right?
Yes.
And it shouldn't be the case. So we're going to cover that now, and we're going to talk about fundamental analysis as well as technical analysis, which are sort of 2 tools that you can use to research, as well as some investment philosophy type pointers. But we're going to be as practical as possible. So really try to walk through an example of some of the things that you might need to look at when you're researching your first investment. And for that, I'm going to hand over now to Isaac to talk about fundamental analysis, just as an introduction of what it is, what it means, and how it works. And as I mentioned, we're going to be really interactive now, so we might go back and forth on a few topics. Over to you, Isaac.
Thank you so much, Tinashe. I think the most important thing that I've learned is that it's very, very important to focus on investing in businesses like what Warren Buffett calls them, that we understand. So what that means is that I do fundamental analysis for stocks that I own. For example, I own Amazon as an example, but I also had a position on Apple. So I do fundamental analysis. That means I take time to evaluate the stock by looking at the company's financial health, business performance, and overall market. So that means I go 5, 10 years behind in the past, 10 years to see if this business was doing well. And there are key things that I will show you in a second that I look at. The first one is that I want to understand the product of whatever business that I want to own, because when I'm buying a stock, I want to understand the underlying business. So I have an Apple Watch here, I have an iPhone. So these are basic products that Apple business produces, and I'm using a MacBook. So that's something. And they also have services, Apple TV and all these, these other ancillary services that they have. But for me to be able to then make that determination, right? I like to invest in businesses that are profitable. So that means I go to the profit and loss or statement of financial position. I look and see the history if they have been profitable. So I don't want to ever invest in businesses that are not making profit, because eventually I believe the market will actually punish them, vote them down. And that's the basic thing. Next slide. And Now, I think let me just go on. So before we go to, technical analysis, I'm just gonna quickly walk you through what I do. There are quite a number of platforms that people can use, but I like to go on stock analysis. This is a free app, but I would then just put, like in this case, I come here, I put the stock that I want. There are different stocks, options here. So if I do Apple here, for example, the first thing that I would do, I would just do an overview of the business. So you can see here, it tells you what Apple is if you didn't know, right? So you can read on this, but for me, that's what I described for you here. Now, for me, the next thing is I want to look at the financial health. I looked at the product, but for me, for the financial health, I'm looking at the income statement. Like, is this business profitable? So you can see here that their profit here, Tinashe, you can help me here. You can see that their net income is here,
Yeah.
right? Pre-tax income is 125 billion. These are in millions. So these are over the years. So it has been profitable. And you can see that the profit has been growing over time. But for me, the most interesting thing is I want to look at their cash and cash equivalents. So it means as of December 28th, 2024, Apple had 54 billion approximately in cash and cash equivalents. So they have cash, even though it decreased. That's something that I would do to go deeper to see why did this cash decrease. But I then go to the long-term debt. Don't want to invest in businesses that have a lot of debt. It's more like an albatross in the neck. So you see, Apple here has 84 billion approximately, in terms of the long-term debt, right? But for me, I also want to see if this business is borrowing this and using this profitably. So you can see here, right? I can go on the free cash flows and on the cash flow statement and look at the free cash flows. So I want the ratio to be reasonable, at least 3 times to be able to pay off this. So if I see the free cash flow, so it means Apple have 92 billion in free cash flows, money that is coming in as a this debt. So it means they can easily pay off their debt, right? Long-term debt, right? And they also have cash, like I showed you. So this is the basic test that I do for me to say, look, is this business healthy? I look at their financials, which is what I just showed you. And I also look at the product and then the competitive advantage. But now I also want to look at what are analysts. These are people who are specialists in this field to see, is it a good time to then buy, to see, because sometimes you can lose money if you just buy a wonderful business at the top. So you really have to, I want to buy it when it's undervalued. So you can see the medium price target here. You can see here it's, let's say, $250, but right now Apple was trading at 224, right? So which is, even it shows that it's undervalued, at least from this analysis, because of the tariff talk. So I could maybe open a position if I'm satisfied, but I would just start to buy. Let's say I want to buy 100 shares, I would just buy 10 shares, 10 shares, 10 shares over time as it drops. And the good thing also is that you can also see that Apple offers, it gives a dividend. So annually, if you have 100 shares, you get $100, and they, pay this quarterly. Every 3 months, you get, money. But the goal for me is not to just, in this case, I want the money to grow, right? Capital gains, but I can just get this as a bonus. So I think that's it for now. But now, moving on to technical analysis, but I just wanted to show you guys this.
Yeah.
Did you want to add something, Tinashe?
Yeah. It's pretty much just to echo the same points.
Yeah.
I don't know if you can pull back that overview.
Yeah,
Um,
sure, I can do
that
that.
fundamental analysis it's essentially trying to figure out if
Mhm.
the business of itself is
Yeah,
healthy, right? And I know
yes,
that I think Isaac has at times talked about um, other
yeah,
topics such as like things that are called like moats, which is
yes,
like a sustained competitive advantage, right?
yes.
Um, because you can have a very healthy looking business, like Nokia was at some point. If you looked at their
So after doing the fundamental analysis, now you may want to then do a technical analysis to kind of like understand like what is the good entry point. But basically, when you're looking at technical analysis, it's just a way of studying the price action. And usually you are looking at, if in this case I'm investing, I'm looking at the long-term time horizon, 5, 10 years, or whatever time horizon you like. And then you focus on the charts to see using like volume and other indicators that we will share with you now for specifically that we use to then ascertain, is this a good entry point from a technical point of view after doing the fundamental analysis. Now, what you see on the chart is these are candles. They are very interesting, and these candles, they have different names. So move on to the next slide, Tinashe. So candles can tell a story, but not to bore you with a lot of details. The most important thing to understand is that if I'm looking at the long term, I want to be buying stocks, around like the, 50. Let's say if you're looking at 50 moving average, it means if the stock pulls to this level and I want to go on for the long term, and I'll do a live example, I want to just wait for it to come here after satisfying the fundamental analysis. And if the business has not changed in terms of fundamental structure of the business, because sometimes
Yeah,
if a stock is dropping, you don't want to catch a falling knife. So that's why it's very important to follow a few stocks and you understand, you read, you pay attention to their earnings, what analysts are
exactly.
saying and stuff like that. So if you are still confident that the business is going to continue going up, I want to be adding shares when it pulls back to these levels, like 50 moving average, right?
Exactly.
And for the long term, you will see that now on average, if I add shares here, I add shares here. But remember, sometimes it's difficult to catch the bottom. So even if I catch it at this, the point is I buy on a red day when it pulls back.
Yeah,
Now,
yeah.
the green candles that you
And
see, it means it was a bullish, and you can chime in, Tinashe.
oh, sorry. I just wanted to double click on what you mentioned about catching a
Yeah,
falling knife
yeah,
and the interaction between fundamental analysis and technical analysis.
yeah.
Um, and maybe we could even look at this from a chart. We'll
Yes,
put something onto the screen at a later stage. But
yes.
um, if you look at Alibaba, so this is one of my stocks that I invested in, and I'll
Mm,
actually say this is one where I actually made a mistake on this one, or rather,
mhm.
I didn't follow best practices in terms of principles because
Yeah.
I liked Alibaba because the fundamentals of the company were really, really great, right?
Hmm.
And even if you go and you look at stock recommendations for
Hmm.
Alibaba, like what Isaac showed on the screen, where the analysts people who look at this company and they analyze the company and they look at the trends, they spend a
Hmm.
lot of time looking at these companies and they basically give a recommendation to say, is this a good company, i.e., you should buy it, or
Hmm.
is it an average company, which is sometimes a hold, or if it's a not so good company, they say you should maybe sell it.
Hmm.
So Alibaba had very high ratings from the analysts, right? It was pretty much a
Yes.
buy, not even just a buy, a strong buy for most analysts.
Hmm.
Um, but the stock chart, i.e., the technical analysis, seemed
Hmm.
to suggest it was on a declining trend, right?
Hmm.
And quite a big one at that. But I just sort of focused only on the fundamentals, and I didn't even try to like dollar average, right? Like buy a
Yes.
little bit at a time. I just went in big time, and
Yeah.
despite the fundamentals being strong, the market conditions meant that the stock just kept going down.
In
And
the
this
short
is one of
term.
those strange factors of life, right? Like
Yeah.
winners keep winning and losers keep losing.
Yes.
So sometimes these charts somehow give you an
Yeah.
indication of what could be going on with the stock, which is why it's always useful to have your fundamental analysis in place first,
Yes.
right? Because you don't want to buy a bad business just because the chart looks good. And then you have
Yes.
your technical analysis to sort of help you understand the timings of when to potentially go in and out
Hmm.
of the stock. So that's just how those two work together. But I just wanted to chime in there because that's where I made a big
Yeah.
mistake that lost a
Yeah.
lot of money.
It is
But yeah,
normal.
thanks.
Everybody, even Warren Buffett, they lose money once in a while. But the most important thing, you should make more money than you lose. Then now we
Yeah.
can move on to the next one to just define the terms, and then we go on a live example. Yeah, you can move
Okay.
to the next
Yes.
slide.
Here we go.
Fantastic. So when I'm doing technical analysis, the most important thing is to understand that price is different from the value of the stock. The price right now for Apple might be, let's say, 224, but each value I showed you from the fundamental analysis, if maybe analysts are saying maybe the fair value maybe is $200 as an example, that means it's undervalued in that case according to various models they use discount model and stuff. So I try to just follow credible analysts but look at the fundamentals and the technicals. Now if a stock is on a downtrend, I want to interrogate what is the reason for it to be going down. For Tesla, for
That's good.
example, there's the brand is warning, the deliveries, the numbers that are telling a story. I like this professor, I think it's Aswath Damodaram from New York. He likes to value stocks using the story and the numbers. Yes, the story for Tesla is robust as an example, but the numbers are telling a different story. Hence, you see Tesla dropped from about 580 to now, trading at 270 after the Liberation Day that we were talking about, Tinashe. Now it dropped. And so this is something that is very important to understand the trend. If I am a long-term investor, I can possibly go against the trend for the short term. Let's say if the trend is downward, I could buy a position if the fundamental and the structural situation of the business has not changed. Now, the price level I mentioned, but there are resistance level, and I will show you what are resistance level, demand levels, and supply zones. Basically, demand buyers are in control. In other words, they are at a level where they can bid the prices up, because basically the price that you see reflected, it means there's an interaction between the sellers and the buyers, because the shares of a business, they are fixed. For companies like Apple, for example, they are multiple millions of shares. So if, let's say, the buyers are in control, it means that stock is more likely to be on a bullish trend. It goes up because they can build the price. Let's say market price, they push the price. But however, if a stock like Tesla, as an example, is unpopular and people might be, selling off, and these people who move the markets, they are big institutions, Goldman Sachs, Bank of America, they do billions of shares. So if they can push the price down, it might be temporary or a long term. So that's important to understand. Now, that's the resistance level. Trend line now is just the line that shows the trend, right? Is it uptrend? Is it going up? If you draw a trend line, as I will show you, then that is very, very important. Candlesticks, I just showed you like those candles, and they have different names. Bearish if it's going down, and then bullish if it's going up. And then there are different types of candles which you can look up, like the doji, which shows that there's indecision in the market between buyers and sellers. Now, moving average is important because it kind of like gives you a trend to say, is it going up or down? Like we gave an example of a 50 moving average. Like I want to buy stocks around that region, right? If I draw a trend line, and I will show you. Then relative strength index, it shows you if the stock is overbought or oversold. In some cases, when some stocks are unpopular, they might be oversold, but usually it's like a rubber band. Once the stocks, and if the fundamentals are good and the RSI is down below 30, it means it's oversold. It most likely are going to start bouncing back, because if big institutions start to buy back, they might now, their buyers, they might push the price up, right? So that's another important thing, and it's mostly interesting for traders. Those are people who may be just doing, short-term buying and selling, or selling and buying for traders. Then some people use the MACD, which is a tool to identify the buy and sell signals. And these are all in softwares. So you can just search, and as I will show you, and then you just, look at them, right, to understand what they mean. So you can just use, like the tools that you understand, and I will share with you what I use. Some people, in this case, if I'm trading, I use stop loss, because sometimes the prices might be very volatile. Like today, when President Trump announced tariffs, stocks dropped. They first went up and then they dropped, as I'll show you. But the more important thing, if you have a stop loss, it means once it reaches that point, even if you are not there, it takes, it exit, or if you want to get into a position, it executes that you get in, right? But this will be after fundamental and technical analysis. Say, I want to get in at this point. Basically, you are automating, because sometimes we are human beings, we are creatures of emotions. So now let me go to the chart to just show you a bit of technical analysis, and you can stop sharing so that I can share the screen from my end, Tinashe. Thank you. Now, what you see here is I like to use this trading software called, TradingView. But what you see, these are the candles that I was talking about, and this is a graph for Apple, and you can see it's for the long term, right? And this is a daily chart. In other words, one candle here, it represents what happened in the price action. It means in this case, the price went up, but this day, it means the price dropped and it closed, down. Now, you see that at the end of the day, you can choose to do if you're trading, but for me, if I am a long-term focused investor, I want to look at the long-term, trend. Like if you draw a line here, it will show you that this is, over the long term, if you're just a dollar cost averaging here, you're buying here, you're buying here, you're buying here, right? On average, your average would be, you will be in the positive. Now, you see, this is the price for the stock today, but after President Trump spoke about the tariffs, it dropped. This is aftermarket. But now, if I look at the technical indicators, and there are many different, things that you can use, like I was telling you, this is technicals. So if I look at the simple moving average, right, you see in this case, I have the simple moving average, and you can see this is like 9 moving average, and I can change it here. Let's say let's say I can say simple moving average, maybe 50, because usually sometimes I use this for trading, right? So now it means this is a 50 simple moving average. So it means if I want to buy, I want to be buying when it touches this, right? So I can buy the stock for the long term, right? At these levels, like once it goes below this or at this level, I start buying. But if the story has not changed, then I can possibly add, let's say if I want to add relative strength indicator, like I was telling you, you see here when the stock is overbought, right? And it means usually it's at this point because investors sometimes they want to take profit. So once they start selling, there is the downward pressure, right? So you see the stock goes down. So when I am buying for the long term, I want to be buying when the RSI, the relative strength indicator, is below 30. It's like at this region. So that's another indicator. There are quite a number of them. So let
Okay,
me.
so
Oh,
so what it sounds like you're saying, and just correct me if I'm wrong, that
yes,
if you've looked at it at the company and you're happy about
yes,
the fundamentals, right?
yes. Mm-hmm.
What you're now just looking for is opportunities to
Mm-hmm.
buy. And
Yes,
those opportunities typically come when there's a pullback, i.e., the stock
yes.
drops. And
This
for
earnings or
that, it
whatever
looks like
reason. Mm-hmm.
you're using the
Mm-hmm.
moving averages. So if it drops below the
Mm-hmm.
moving average, which is basically the average price of the stock
Yes,
historically,
yes,
or you can use this RSI indicator, which
yes,
indicates if it's
yes,
overbought or oversold, or maybe in this
yes,
particular case, looking for
yes,
cases where it's
yeah.
oversold. Okay, okay, understood.
Yes, and you can play around with them, and I can use, let's say, the Bollinger Band, for example. It does the same thing, but what the Bollinger Band tells you is if I look at it, I like to be buying a stock at these levels. Like once it comes here, I see the Bollinger Band is right here, right? I want to be buying at these levels, and I want to be selling at these levels, right? So once I see that the Bollinger Band is up, extended like this, I want to sell. But it's extremely difficult to time the market. So when I'm investing for the long term, I want to just see maximize my endurance in the market. If I'm compounding, I'm just buying on average and average, and then I sell maybe over the
Mm.
long term. And another
Okay,
important thing, it's okay to exit the position if the story of the business changes, right? Because sometimes you might have unrealized profits, but then maybe there's something that can fundamentally change the business. You may want to just exit even at this point to cut your losses and to manage your risk. Tinashe, you can ask the question. Sure.
okay. So just in terms of like
Mhm.
the topic about the story of the business, um,
Yes.
um, sometimes it's always very hard to pick what that is up, but
Yeah.
maybe a good example right now, and who knows,
Yeah.
in 3 4 months
Yeah.
that could have changed. But at least in theory, one could say like Tesla, for example, has had a
Yes.
very um, positive story for the last
Yes.
4 or 5 years, right?
Yes.
Their deliveries were increasing. Um, the popularity of the company was really on a high, and
Yes.
the overall thrust of electric vehicles was really positive.
Yes.
Um, Now, what's an example of that story
Yeah.
changing that may make you think, well, maybe I should reevaluate if
Yes.
this is a stock I should still be buying, or
Yes.
maybe exiting, or maybe even just reducing how much I own? Like, what are the type of things that
Yeah.
uh, can happen
Yes.
to think that the story has changed?
For me, I'm looking at the profit margins, for example, right? To say, is the profit margin growing? Number one. Are they, is also the leadership. Remember, I said I want to look at the leadership. Who is leading this business? If the leadership is actually, like in this case, Elon Musk, as an example, is now, in the White House doing this. So he's now an absent CEO technically, right? He's focused on other things. Now, that is an issue for me if I'm an investor. So I look at all those things, right? The other thing that I like to look at is like to look at the balance sheet, right? To say, is it increasing debt? And is this stock still, I go to on the investor relations on that business, right? Or most publicly listed companies, I think, or even the Security Exchange Commission, which is the, where you see these filings. I read, I take time to see, are there things that are happening in terms of the mode, the competitive advantage? Are there other players, like in the case of Tesla, there's Waymo, there's BYD, which is also innovating. So if those players are coming in, what it means is Tesla probably have to reduce the price to retain the market share, right? So the competition is getting tougher. So I'm looking at the macroeconomic environment. So what this means in short is that you have to pay attention to the stocks that you own, understand, what is really happening, read the news, but sit back and understand, what's really happening. Now, another important thing is the macroeconomic situation. If, let's say, the Fed in the US, for example, the government, does like the tariffs, companies like Apple, it might be affected, because if then China targets Apple, because President Trump, just I saw on Bloomberg, he increased the tariffs to 34% on China. So if they target, it's very vulnerable, because the manufacturing sector, the same with Tesla. But the key thing there is to understand, is this something you should ask yourself, is this something that's going to fundamentally change the business over the long term? If I want to hold this business for long term, and I mean, if it's the tariff, President Trump, if he doesn't change the constitution, he'll be there for just 4 years. So I might actually take an opportunity to maybe add some shares, for example, if I'm bullish on this. So, but these are key things. Now, in conclusion, I wanted to share the resistance levels. So what we do is, when we are charting, is we look at these. This is a demand zone. Basically, when you see this, it means buyers are in control. These red lines, these are called, like, sellers, like supply zones. Usually when the price comes to this level, it tends to hit at this point and goes down. If you look at in the past, when it came here, the price bounced back, right? And then there was a break of structure here, or to the upside, it went up. But then at this point, there was a supply zone here, it dropped. But then there was a liquidity, what we call a fair value gap. It had to come back and grab this liquidity, and it went back. But now, at this point, there are a lot of orders that are at this level. So likely, this stock is going to bounce back at this level, this resistance level. So if I am an investor, I may want to just buy at these levels, right? I can just say, okay, I'm going to buy at this. And let's say if I'm looking at the long term, I will buy at this point and sell maybe at this point, maybe be slightly below at 240. So that could be kind of like a trade. So what some people do is, I just put a buy order at this point and then a sell order at this point. So when it hits here, it executes your order, I get into the position, and then when it goes up, I sell. It automatically sells. So those are kind of like nuances, but if you really then want, the basics, the specifics, of this, Tinashe and I will be very happy to, walk you through, because every situation is different. Over to you, Tinashe.
Yeah, thanks, Isaac. And
Mhm.
I just wanted to, you know, just highlight, this idea of the buy zone, sell zones,
Yes.
and like what's been helpful for me to sort of think through this in terms of like why there's certain levels where the price is likely to bounce back up, right?
Mm-hmm.
If you imagine a situation where I've got a gift voucher,
Mm-hmm.
right, that costs a gift voucher for 100 US dollars, right?
Mm-hmm.
If I, go to people and say, hey, I have a gift voucher for 100 US dollars.
Mm-hmm.
I don't need it. Um, I want to auction it, right? And I
Mm-hmm.
say, I want to start auctioning this thing at $50, right?
Mm-hmm.
So the number of people who are going to be interested in buying something for $50,
Mm-hmm.
right? That you can automatically convert to $100. It's going to be high, right?
Mm-hmm.
So if I were to put this on Twitter or online, the number of people who are likely to send me messages,
Mm-hmm.
right, putting in a
Yes.
bid, going to be higher, right?
Yes.
But as the price goes up, right?
Mm-hmm.
So at $50, the buyers are in control, as we're saying. As the
Mm-hmm.
price goes up, there's less demand, right? Because now if I'm selling it for $75, a lot of people still may want it, but some people might be like, "Ugh, then I have to buy this gift card and then I have
Yes.
to go and, do all the admin."
Mm-hmm.
And as the price gets to a certain level, let's say $100, then maybe there might not be that much supply.
Yes.
And at that point, if I haven't sold it, the price will start to drop for me to get that same level of demand. So that's sort of
Yeah.
how things typically work when it comes to buy zone and demand zones
Yeah.
as well. But that's just one example. But I think, like what Isaac said, we can always, specific questions people can sort of drill back and ask, and we'll also give you a whole lot of resources
Yes.
afterwards to sort of read up uh,
Yeah.
on that. So we've looked at fundamental analysis, technical analysis, just the basics.
Yes.
Um, and this might feel quite overwhelming for a lot of people because it's like, okay, I need to read all these financials. I don't even understand what these things are. I need to
Mm-hmm.
understand all these charts.
Mm-hmm.
But one of the good things about investing is that if you're particularly starting out and you're, trying to figure out your way, and to be
Mm-hmm.
honest, even if you're really an established investor,
Mm-hmm.
one of the most effective ways to invest is not to try to identify specific companies because, like
Mm-hmm.
as I said, then you have to follow the story of the company. You have to
Yeah.
know what's going on.
Yeah.
And for a lot of people, they might not have the time for that or
Yes.
even the energy. So
Yes.
what you can do is you can buy the market, right?
Mm-hmm.
Essentially, buy an ETF that tracks like the S&P 500, which is indicative of the entire
Yes.
market.
Yes.
So what that means is that you don't have to worry about individual companies.
Yeah.
You're just buying the whole stock market.
Yes.
And actually, historically, that approach has worked out better
Mhm.
for investors than even using
Yes.
dedicated full-time professionals investors to
And you
manage.
know why? I think
So
it's
as it goes,
most yes, it's mostly because we are creatures of human of habit. Sometimes fund managers they are over trading and sometimes they panic. So as an individual investor, retail investor, like in this case, if you have a long-term time horizon, you can just hold on. Another example is sometimes people want to use leverage. Now, what happens if the market drops unexpectedly and you don't have an emergency fund? You might be forced to sell when it's down. And another reason is that, let's say you have five stocks, Apple, Microsoft, and let's say whatever stock that you want. Maybe the other stocks, maybe on average, they go up by 30%. And you have one stock that, let's say, goes by 50%. Let's say for Tesla, for example, it went from 485 and you had it went down by 50%, right? And the other ones, maybe they just went up by 2%. But the S&P 500 now, it is a basket of, companies, 500 of them. And in some sectors, they are all outperforming and underperforming. But on average, it has tended to perform better. So it's very difficult to pick the next NVIDIA. It's always easier to look back. So what I do is it's very important to allocate your portfolio. So if you have 5 stocks, make sure the simplest way is to just make sure that maybe just divide by 5. Don't allocate more than 20% in one individual stock, unless you are extremely difficult. In my case, I actually like to have 5% at most in one individual stock, because if you are right, it can still go up. But if you are wrong, it's not going to kill your portfolio, your overall performance. So that's why, a lot of, fund managers, they also don't outperform the index, also because they charge, let's say, 2% fees. So if the ETF SPY returns 10%, in real term, you have 8% because minus the fees. So if you're just doing dollar cost indexing, the fees are generally, they are lower. So those are things that you have to look at.
That's a very good point. And I think
Mhm.
for your first investment or your first portfolio of investments, you probably should maintain a significant chunk
Yes,
in that so that your risk profile is
yes,
not too high. I
yes.
know there's always a lot of temptation to buy like meme stocks like
Yeah.
you know GameStop or um,
Speculative
um,
stocks.
which are the other ones, right? Which
Yeah,
gone up 10,000% in a short space of time.
yeah.
Um, you know, but like I said, the goal here is to invest and not to gamble, right? Some
Mhm.
people really understand those businesses in those sectors and have a particular thesis. But
Yes.
if 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 you're a starting out investor and
Mhm.
generally speaking, if you're not like dedicating a lot of time to this,
Yeah.
you should probably try to stay away from those.
Yes.
Um, so that actually is um, the end of this particular lesson, which is on researching your first investment. So to give a bit of a
Yes.
recap, you
Yeah.
want to understand the fundamentals of the business, right?
Mhm.
Look at the financial statements, look at the management team,
Yeah.
understand the philosophy of the company and what they do, their products, right? Try to do things that are, try to look at a company that's within your realm of knowledge and understanding,
Yes.
right? Something that you're familiar with, right? And then after that, once you've gotten a good feel about the long-term prospects of the company, look at the chart to try to identify when might be a good time to sort of get in and buy, right?
Yes.
You don't have to be very complicated about it. You can just kind of come up with a rough idea and then
Mhm.
dollar cost average, which basically means, don't spend, if you have 10,000 to invest, don't buy
Yes. All
10,000
at once.
all
Yeah.
at once, 1,000 at a time, for example, at different levels, so that the average cost you're getting in is actually quite good.
Mhm.
And then lastly, keep a significant portion of your portfolio just buying the market, which will
Buying
help
the
to
index.
mitigate
Yeah.
your downside as well. And if you want to really design your portfolio, people like Isaac, that's a lot of what they do. So
Mhm.
you can also get some additional advice and support on that. Um, so
Yeah.
yeah, I think that's it for this lesson, and then we'll move on to
Yeah.
um, the last lesson, which is
Mhm.
lesson 4, which is actually the practicality of executing your first trade.
Yes. Yes. Yes.
Actually, I don't know
Yes.
if that's lesson 4. Actually, what is lesson 4?
Yeah. Yeah. I think